in the most intelligent or the most planned out fashion. So for today, I think we're going to learn quite a bit about this process. National Gold Consultants is in a unique position where they are the only one that's dealing with individual and independent advisors out there, guiding them on how to position this topic and this solution to our clients. So with that being said, I would like to just go ahead and turn it over to Kerry and to Ryan and let them take it away. Thanks, guys.
Thank you, Bill. Hey, everybody. So just to clarify, my name's Kerry Morris, like you said, and I run my own financial practice for many years. I just happen to know this guy you see there with no hair on the screen for many, many years, and met him at a meeting from my registered investment advisory a long time ago, and we got to talking. He did a presentation, kind of just like you're seeing today, because the story of gold and silver, it doesn't change like the headlines do. It stays, there's a solid part of it. And so I knew we needed something like this in our practice, and I began to do that, which you have the opportunity to do after today. And Ryan and I just became so close over the years and understanding the message that I'm like, hey, I'm going to help you educate, advisors. So we do a podcast, we do these webinars together, and I just try to give you a little flavor of what it's like on the advisor side, because as you'll hear in a minute, Ryan's second generation. So the idea of you introducing precious metals to your client portfolios, it doesn't have to be complicated. Okay. And we hope you see that today. So in the next 30, 40 minutes, Ryan and I like to keep this moving. Okay. I don't think it's a long, dreary, boring webinar at all. I think we're going to keep it moving. We're going to give you some foundational knowledge. We got to build in some foundation and just talk to you about the world we're in. First of all, we want you to know somebody's answering these questions, you guys. Am I still taking too much risk? Will my retirement income keep up with inflation? What happens if the market doesn't recover quickly next time? Major disruption coming. I could have a question mark there, but I guess there's an exclamation point, Ryan, because think about it, you guys, between AI, which really I'm kind of tipping the hat on this next one, is the world changing faster than my portfolio. Between AI and the probably likely disruption that's going to happen before there's any kind of utopia that you hear talking about, we also have a market that's like way oversold right now, right? Like we're definitely in bubble busting territory. How long that'll stay, who knows? So it does say next time question mark, but your clients are wondering about this. And what can I do to protect what I've built? So that's why we're here today. What can your clients do to protect what they built? And the old wise owl says, but why? Well, the people are asking this question because whether they're the kind of person who's listening to the talking heads every day or not, they're feeling the stress of what's going on. And they know that something's about to happen. I was on yesterday with an engineer, Ryan, and this guy, man, he's like never met a spreadsheet he didn't like. And we were talking about Roth conversion, of course, and he had it all mapped out and everything. But he himself knew that there was some danger there, So today, though, for you, what can this mean for you? What can this mean for your practice? The old whiffum factor, right? Because you spend time servicing clients, marketing for new clients. That's expensive. That takes a lot of time, and so to be able to add a new opportunity to that doesn't cost you any more dollars, but can bring you more revenue and help your clients, to me, that's a huge win, And so if you're doing FIAs, life insurance, maybe you're a Medicare, maybe you're an AUM guy. I don't have that on there, but this is just an easy add-on, gold and silver. NFI is there to facilitate all this for you. And so, Ryan, let's bring Mr. Long in and let him talk about licensure, because there's a few things we like to get out of the way, you guys, and that's licensure and compensation. And then we'll go into some really nice content.
Yeah, Kerry, because you and I have been doing these presentations for a very long time now, a decade plus, right? And when we're talking with advisors, we want to make sure they don't have the cobwebs are over them. They go, well, that all sounds good. I can't do this. I'm not licensed for this, or hey, I don't want to have to get an additional license for this. So like what you said is we want to completely get this out of the way. This is for everyone on this webinar right now, whether you're watching it now live or whether you're watching this as a recording. The big thing is this is not a security. Doesn't matter if you're an AUM guy or not, like Kerry mentioned. I personally, we work with them all, right? But I would say maybe 75% of our individual advisors and agents are insurance licensed only. So if you find yourself on this webinar going, hey, that's me, well, you're the norm, because you're also the norm that leaves typically 30 to 40% of clients' assets on the table, essentially for another advisor to gobble up. Okay, so we like to get this out of the way. Your way here is, yes, you get paid for it. Not a get rich quick scheme, but what Kerry mentioned in the previous slide, this is just that last proverbial puzzle piece to what you're already doing. That, hey, you're able to add in another piece of the pie for your existing clients, your prospects. This is a great and easy conversation. But yes, 4% for non-qual Kerry, 3% for qualified, and here we are, got it out of the way, right?
Yeah, and the sticky factor, like when you're the one to bring this up to clients, there's something that they open up even more to you. They're like, wow, this guy's really thinking about what's going on, and so whether it's, and just so you know, these aren't $5,000 and $10,000, $20,000 sales, so to speak. They're usually 50, 80, 100, 200, 250 and on up, because it's an allocation percentage of their portfolio. We'll talk about that in a minute. So another foundational part of this, guys, we just want to touch on before we get into a little bit more education, is why physical and not ETFs, right? So that you can access gold and silver in a way through ETFs, GLD, SLV, and we just want to talk about that. And I love Ryan's story that I've heard for years. I'm going to let him tell it to you.
Yeah, Kerry, and I don't know if this is a market shift that's occurring, at least this year or now that the summer doldrums are over, but I'm having more and more advisors that come to us brand new that are going, yes, my clients don't want an ETF. They don't want a piece of paper because, we call it the economic storms, or when that owl was blinking at you, of all of the what ifs of, there's just a lot of noise in the background. There's a lot of unspoken, I'm not going to call it fear because we're not doom and gloom, but just an unsettled feeling that's out there. And when things are unsettled, the illustration I give, Kerry, and I've said this for more than a decade now. Well, here I am. I'm in St. Augustine, Florida. I'm closer to Port Canaveral, where the cruise ships deploy, than I am Disneyland or Disney World, right? And so if I was to head down Interstate 95 and I hit Port Canaveral, and the cruise vessel that we happen to be on happens to be going on to the Titanic, right? And this Titanic, we know the history of what this vessel did. We reluctantly still get on, and the crew member goes, "Hey, Ryan, knowing the history of what this big boat has done, I'm going to give you two options. The first option is I'm going to give you a life preserver that you can have right now in your hand that you can put around your neck, or I'm going to give you a certificate saying you own said life preserver." Right, which I don't know about you. I know what I'm going to take, Kerry.
I know what I'm going to take too. Absolutely. And so what we're talking about here, you guys, is the difference between the paper shares you see there on your right that are highly leveraged, right, and highly volatile, because they're a security. So they tend to move with the market. Now, let's say the market has a big sell-off and they start going down with it. There come a point where, because they are linked to gold and silver, that they'll break away a little bit and begin to catch some traction back towards the upside. And that's why they're good to have in like a 401k, or it's not that we're against paper shares. It's just that that's not what you want to count on for your wealth protection. The other thing is they're highly leveraged, right? I'm going to steal one of Ryan's lines that he says every time, and possession is 9/10 of the law, right? People understand that. And that's it's funny what you just shared about the feedback you're getting lately, Ryan. So highly volatile, highly leveraged. What do I mean by that? I mean, they'll sell 200 or 300 shares off the same piece of metal, right? And so there's no like redemption thing. You can't go to a window somewhere and say, hey, I want to trade my paper shares in for a real physical life preserver. It doesn't work that way. So, and I always like to do this to Ryan. So what do you think, how much gold is that today, Ryan? Because over the years, that pile on the left has changed value. What is that worth today?
Well, and Kerry, that is 10-plus-year-old picture. And 10 years ago, we were illustrating what $100,000 of gold looks like.
Yeah.
Right. That today, you're probably looking 250 to 300.
Yeah. My clients are very happy, very happy. And we don't do this, you guys, as like a big get rich quick scheme. We're going to show you that in a minute. This is slow go, long haul, counting on very, very foundational things. Okay. So I want to talk to you about National Gold Consultants for a second, because that story can become part of your story. Okay. So Ryan and his dad started this a long time ago. He's second generation. That's actually his dad. I put his dad in there as a little cameo because his dad hasn't been part of the business for years since he retired. But I just surprised Ryan with that one day. And that little name tag you see on his belt that says dad on it, it's really cool. Anyways, so Ryan's got a great team. It's really like an IMO for gold and silver, because he's had partners in the past that did have insurance agencies. Ryan was licensed in the past. He's not just some outside guy who's like trying to do good gold and silver in the financial space. He's been part of it for years, and they're the only company I know of that actually works solely with financial advisors. And so my little 3 or 4 minute National Gold Consultant story it's a big part of connecting me to something bigger, something more experienced, letting them know that I don't have to know all this, right? And you're going to see that it's not rocket science, right? You just have to understand a few foundational things. So that story is very attractive to clients, the National Gold Consultant story. And so, Ryan and his team are accessible to support you. After you do your initial part with a client, they're there to do all kind of stuff we'll talk about in a little bit, right? So next foundational item. So far we've talked about paper versus physical, right? Now we're going to talk about just economics on how our country went from basically the government had a debit card because they had controls on how much money they could print, based on how much gold we had, to a credit card, Ryan.
Yeah, and Kerry, this is probably the most foundational slide that we're going to show you, really to set that table. So we mentioned all these aforementioned things of that little owl blinking at you, right? All these market, call it nuances or just different noise in the background. It all stems down to this, right? So here we are in 2026. How did we get here? Well, I like to interchange that credit card that you're seeing in front of you with a debit card, Kerry, right? Because prior to 1971, our entire government, our entire budget, so to say, was a debit card type of a spending. They cannot print dollars, right, without having the physical gold and silver behind it in Fort Knox to back it up. So that was in 1971. We have it circled right there in front of you. I'll call a spade a spade. That was the demise of our currency. Okay. that is when President Nixon got up to the podium and stand and here he came up and said, we're going to temporarily suspend the gold system, the gold and silver backed system, right? Here we are in 2026. We are still temporarily suspended and we got off the gold standard. Well, if you look at this slide in front of you that's busy, all the way to the far left, that was the year 1913. That was the creation of the Federal Reserve. And I've been a part of groups and gatherings of advisors, of hundreds to thousands of advisors, Kerry, and I would take a poll and I said, raise your hand if you think the Federal Reserve is a private entity. And in a group of 1,000, a couple hands would come up and they all look around like, this guy came from Mars. But that's the truth. The Federal Reserve is a private entity, not a government entity. They control the money supply. And since the creation of the Federal Reserve, and then we got off the gold standard in 71, our dollar has lost over 98% of its purchasing power. Okay, that's where we are right now today. So what did President Nixon do with that sweating pig? Is in 71 they went from a debit card to now a credit card, and that's where this debt and deficit and inflation, all these environments that we're in right now, that is where things have ballooned to here we are. And it's no surprise why physical gold and silver are rising. And it's no surprise that it will likely continue to rise if they keep these current monetary standards.
Yeah. So fact, right after 2008 in that crisis, really for the first time in history to this magnitude, it took the government about 5 years to print $3 trillion, you guys, out of nowhere. Okay. When COVID hit in 2020, it took 3 months. They printed 3 trillion, infused that into in 3 months, they printed 3 trillion, infused that in to recover. Right. So one of my big questions is, I wonder about the future is that going to continue? Because at what point do we get up against the wall where that is not really doable anymore? Because we just hit a milestone, Ryan.
Yeah. Kerry, I said the government turned 40 just this last week, right? This national debt, and I wrote it to our advisor database that goes to over 6,500 advisors. If you're not on that, type in the chat your email and we can get you on that. But I had a little fun with that this last week, Kerry, and I made a pun of, when your body hits 40, they call it over the hill, right? Well, yeah. our government just hit $40 trillion of national debt. And if maybe you're on here as a wise guy and you're going, well, that's not the whole picture because of the unfunded liabilities. I mean, you're not wrong. That number's over 200 trillion, but I'm not going to cover that today. But that's where we are.
Yeah. And so I'll draw attention to that little black circle on the bottom side of that little chart there, you guys, that 122. What is that? Well, that's the debt to GDP ratio, right? That's money coming in versus money going out. And let me just tell you, the bottom line is you do not want that over 100. That means it's upside down. And it's been over 100 for quite a while. And so that's why, we don't, it's not sustainable. We'll see, who knows? I mean, they may just, a lot of times you kick the can until it just falls off a cliff, right? I don't know. We're not trying to predict that. And we don't have to predict that. But we do have a responsibility, all of us, to help our clients prepare for whatever may come, right? They've spent their whole lifetime building whatever nest egg they have when they come into retirement, okay? And they're depending on us to help to know, like, what's down the path, what are the threats, what are the weaknesses in their situation that they may have, right? That's why you use FIAs. That's why you use cash value life insurance, because let's face it, you guys, this is the 401k generation. Like, all they know is 401k, saving in the market, right? Ever since 1980. And so you use all these tools and you have that message that you have for protection. And so there's an element to physical gold and silver that we'll go into next that's all about what we call wealth insurance, right? So that's some foundational issues, paper versus physical, a little background on our monetary system and why we are so far out on the ledge. And right now we're going to go into 3 different things that historically operate inverse to the dollar in 3 different, well, here's the 3 things right here: US dollar, real estate, and stock market. So they tend to operate inverse to gold and silver. So anytime you have an asset class, 2 asset classes that work in generally opposite directions, when one goes down, the other goes up, you want to own both of those, right? And that's all we're saying, Ryan, is that seesaw has nothing on the other end right now.
Precisely. All this is a counterbalance. And you mentioned that this is not a get rich quick scheme. Yes, you mentioned your clients are happy, right? Because you met us 15, 20 years ago, right? Well,
yeah, and let me add right there, when COVID hit, you guys, and I do money in the market, I do all this stuff, right? I'm a CFP, I build plans, that's what I do. And so with the counterbalance that the gold and silver provided at the proper allocation, I just wanted to add, Ryan, that when COVID hit, you guys, I was shocked myself. Obviously, I was communicating with clients. I was doing different things, but I got 1 phone call and 1 email out of concern, because they had been taught and they knew about the seesaw and they knew that they had something on the other side of it. Sorry, Ryan, I just had to throw that in.
No, that's a great nugget. So let that sink in. So when asset classes trade places, and you mentioned this earlier, that's not that doesn't mean you want one or the other, right? You're not speculating. You're not having all your eggs in one basket. When we're dealing with the 401k generation that approaching retirement, in retirement, have assets to protect, we've already done our job, right? They're already our clients. We've already diversified them, and NFI is fantastic with that, right? You've already stabilized everything. But what happens when we have we see the $40 trillion number of our dollar, right? Real estate's at an all-time high. The stock markets are still all-time highs, right? So what happens when we have a decline of one or three of these things? Historically speaking, your gold and silver rise accordingly. And Kerry, I don't know how many times I'm in my conference room and I use this seesaw teeter-totter example on a daily basis, and I'm just sitting here like this. All you have to do is this. You don't need some fancy graphic. I'm not a chart guy. I'm not an illustration guy. I'm a visual person, right? You sit here and go, great, here you are. But all this is it puts it into perspective. And I tell my folks and my clients, and I say, great, now that you have your physical gold and silver involved inside of your plan, your overall picture, I hope your gold and silver get crushed. I hope you lose your shorts. And I shut up and I pause and I wait for them to say something or move. And they big eyes, just bug eyes, look at me and they go, why would you want that? That doesn't make any sense. And I go, because the majority of your assets are on this side of that teeter-totter, right? If your gold and silver rise, that means, which is the majority, and I'm going to spoiler alert, Kerry, about 80% of clients' assets are on this side and 20% are on this side. It's one of those be careful what you wish for type of scenarios, right?
Yeah, absolutely. Absolutely. So that's the inverse relationships. We're going to give you 3 quick examples. We could actually teach a whole day workshop. We could teach 8 hours and just prove to you all the historical examples, but obviously we don't have 8 hours. So we're going to give you 3 quick little examples of these relationships. So this is the inverse relationship with the dollar. So check this out. 1950, 1 silver dollar would buy you 10 gallons of gas, 26 cents a gallon, $2.60 for 10 gallons of gas. That same silver dollar in 2026 will buy you 10 gallons of gas. Okay. That's the purchasing power being maintained. Remember a few minutes ago when Ryan said that the dollar had lost 98% of its purchasing power? That means that it takes more dollars to buy the same amount of goods, right? And I forgot to add the steak dinner on there. Gold and silver has gone up so much. It's 10 gallons of gas plus a steak dinner, Ryan.
And how many times have we said this, and then we had to add that in, Kerry, just this last year, because this is just an acceleration of the loss of our purchasing power. It was a big deal, Kerry, when we were going through the slides, and it was the 2008 crash, $3 trillion they added over 3 years, and then we're like, whoa, we got to update things, and now it's $3 trillion over 3 months with COVID. Well, now you're looking at this, Kerry, and when the government hit 40 trillion, now that we're over the hill, they added that last $1 trillion in, it was just about 100 days.
Oh, man.
There's a reason why this silver dollar that I'm holding, not only buys you still that same 10 gallons of gasoline, but now we can add an accelerant to it and say it's not only preserving, it's protecting.
Yeah. Because instead of $2.60 for 10 gallons, now it's what, 35, right? 35, or depending on your vehicle, maybe 40 in my old Lexus. So here's the real estate snapshot. Again, Ryan has an incredible presentation. He can show you almost 100 years of this. It's nuts. But here's just a snapshot from 07, 08 of a real estate ETF going down, the gold going up. In that time period, just that inverse relationship with real estate. Okay. And we saw that big time in that financial crisis of 08, because real estate was affected so bad. It really showed it big time. So now let's talk about the market. We got a couple of different slides. I've got this marked up for you here. Those black arrows, this is Dow Jones versus gold, 1996 to present. Okay. The black arrows are inflection points. So remember when I said 2 different asset classes that trade places? I'm showing you here how they trade places and what that looks like over that period of time. Ryan, you want to comment on this before we go?
I mean, you could zoom in or zoom out on this chart, and I don't know why it has such a weird spot for the gold there with that big decline. That didn't happen.
Oh yeah, yeah, that's an anomaly. I've never seen this site do that before, y'all.
Yeah.
But just ignore this little drop right here.
That didn't happen. But the main, again, going back to this, I can't hammer this enough. When you have an asset class that trade places, that's when you want both, not one or the other. But if you zoom in or zoom out, you can skew this data. That's why we showed the last 96 to here we are in 2026. If you show 20 years, that number looks different. If you show the last 5 years, they both have increased. So there are times that they both rise at the same time before they have that inflection point, and that's the scenario we are in now. And I'm not going to get into too much detail as to why, Kerry, but China has dropped 53% of their treasury holdings in the last 3 years. And so you just let this sink in. And what does that mean? Well, they're dumping our government debt, and I mean, and they're buying gold, right? So that's what's happening behind the scenes right now, and why we have both the equity markets and gold and silver rising in tandem. Here we are in 2026.
And see, if we make the mistake, you guys, of letting ourselves think about gold and silver like we would securities, we would look at that and go, wow, well, gold is inflated too. It's in bubble busting territory, but here's the thing. What did we just show you a couple minutes ago? $40 trillion debt. Okay. Have you ever held a beach ball underwater in the swimming pool? What happens when you let go of it, right? It goes up. So the point is that sure, gold it could come down some. Ryan and I don't care, right? We don't care what it does. We just know, and my clients know, that its job is to simply counterbalance. So if the market zooms up all of a sudden after whatever happens with AI, if we have some rough years and then all of a sudden it zooms up afterwards. By the way, you guys, Gemini itself thinks there's a 75% chance that there'll be really major financial disruptions before the good stuff. So I went down a rabbit hole with Gemini one day, and it was really cool. So long story short, there's just all these supporting reasons why for hundreds of years, gold and silver is great wealth protection. Here's a quick snapshot at the expense of the busiest slide in the deck, right, Ryan?
It's very busy, but we put it on here for a reason. It shows the S&P 500, some of the largest declines, and it shows what physical gold and silver does, right? And don't get caught in the physical pre-1933. Yeah, I mean, that's all the silver dollars. I mean, we cover all of this in our training that we're going to give you access to at the end of this. All we're showing here is that trading places type scenario. Why, you look at the 56% drop in the S&P 500. That was during the 2008 crash and recession. You look at what gold and silver did during that time. That's because it was an everything crash. Our dollar's purchasing power, real estate, and the stock market. So it was a triple whammy type of a decline, and that's when you have your big runs in gold and silver. Because let's be honest, Kerry, as a consumer, I mean, we saw this left and right during that time. Everybody's 401k, before October 9th, 2007 was looking pretty good. By the time it all ended, your 401k looked like a 201k, right? And that is when everybody panicked. That is where, as advisors, as influencers in front of our clients and prospects, that's where we need to sound the alarm to say, hey, I'm in Hurricane Alley here in St. Augustine, Florida. My house is surrounded by all four sides of water. I'm on a barrier island. To say that I don't have hurricane risk is an understatement. I'm not going out there in the marketplace now and shopping for hurricane coverage or flood insurance when there's a named storm on the horizon, right? You can't get it. You also can't get it after the fact. So
and go ahead. Sorry.
No, I was wrapping up. That's where, as advisors, we come to prepare our clients for.
Yeah. And so when you're talking to your clients, tell them, like, listen, you are not wired to be great investors. We're not. Okay. History will show that. If you look at the psychology of a sales cycle, of a market cycle, not a sales cycle, but that's our problem, right? Sales cycle. If you look at the psychology of a market cycle, why do people inevitably sell at the bottom? Okay. Because they're not psychologically wired. That's part of your message when you're out there with the safety message, is to say, hey, it's almost like counterbalance to our wiring and our psychology, Ryan, because we just don't do well. We're going to hang on, and then it's too late, just like you said. Hey, listen, history provided us one more glaring recent example of this counterbalance, and this is 2020. You see S&P, there's negative 31. Silver spot price, that's your paper shares, dropped 36. But the physical that we do for non-qualified, the pre-33, was up 22. So this is why, a big reason why, and proper education of my clients, this is why I only got one phone call and one email out of real concern in 2020. So just one more shot there at these things. So that's what we mean by counterbalance, you guys. A few quick little historical examples, and we're going to wrap up here in a second. Ryan, I know you like to touch on this first. I mean, look at that, Ryan. Everything they own is on that side of the seesaw.
Yeah. It's because, Kerry, everything we own is valued based on our dollar, right? The dollar's perceived value. So, I mean, again, I look at real estate, right? I've got 100 years of data that I can show when real estate's high, gold and silver's low, and all they do is just trade places. 100 years of data. It's crazy. Well, no secret to where, if I'm a layman's term and I go, wow, when is a good time to buy gold and silver? Well, if you don't have any, you're going into hurricane season without hurricane cover. So it doesn't matter what the price is. But if I'm a consumer, which we are, am I getting a good deal? Yeah. I mean, if real estate's high, historically gold and silver's low. And that's where we are now, Kerry.
Absolutely. So how much does it take on that end of the seesaw, Ryan? Talk about allocation for a second. How much gold and silver physical metals do we want as a percentage of our overall liquid nest egg?
Yeah, so I did a spoiler alert probably 10 minutes ago, and I apologize. But 20% is the number, right? That has enough weight, pun intended, to counterbalance and offset all of our other dollar-based assets. So what I tell folks is this: 20% is more of a neutral position, right? You're in retirement, you want this wealth balance because you want to grow your assets, but you also, if your 401k turns into a 201k, you don't want to change your standard of living, right? That's the whole purpose of retirement, to not have to look over your shoulder and sleep with one eye open. Okay. Years ago, that number, we used to say 10 to 15%. Right. But things are accelerating. We're not the only ones out there that saying 20% is that new norm. If you're a client of Morgan Stanley now, you're at 20% exposure to gold and silver. Right. They used to, and this is what's huge, Kerry, that 60-20-20. Morgan Stanley prior to this last year was a 60-40 portfolio, stocks to bonds. Okay. So they came out last year and said, well, we're going to, not eliminate, but we're literally going to take a machete and cut our bond exposure in half. And we're adding, instead of 40% of a portfolio of bonds, we're just going to go 20%, and we're going to add that last 20% into gold and silver, Kerry. Crazy stuff that's happening.
Yeah, I mean, and then you got Reuters there, global market. So what are other people saying? High quality equities and gold are the best hedges, Wilson told the Reuters Global Forum. I mean, here's some other, just a few things for you. I wanted you to hear what other folks are saying. Here's Wisdom Tree Europe. Optimal gold allocations for investment periods of 10 years. The optimal weight to allocate gold would have been 16 to 20%. Oxford Economics, 14.2 to best preserve real purchasing power. There's some language above that has to do with, it starts off with a 10% goal, but it says, in low growth, high inflation, you need more. That's what we're saying too. Down at the bottom, Ray Dalio, okay, founder of Bridgewater. You guys know who Ray Dalio is. If you don't, look up what this guy's done in his life, what he's built. And he's an equity guy, he's a market guy, but he's saying, hey, I think you should have a part of your portfolio in something like gold, which is very excellent diversifier of the portfolio. I think that having something like 10 to 15% of your portfolio in gold is a healthy amount as an insurance policy. So Ryan's saying 20 because of what we've seen in the last few years. You can say 15 to 20. You can see if Ray Dalio is saying 10 to 15, he's always going to hedge towards having more in equities. He's never going to be willing to go there. But here's what the real point is, Ryan, and I want you to address this, and then we're going to wrap up, you guys. The real point is this. One of the worst things that we see advisors do is get signed up, get going, do their training, which we'll talk about next. And then they go out there and they don't understand the allocation language. They don't understand that if a client doesn't do enough to put some weight on that seesaw, I mean, if I put my little 8-year-old son on the other end of the seesaw, I ain't going nowhere. It's not going to counterbalance me, you know? So that's why we're talking like, you know, if your client has $500,000, well, 20% of that's 100K. So you could take it right out of the market. You're probably not managing that anyways if you're not securities licensed. And you know, once they understand that, they can move that right out into that allocation. But let's say you teach it correctly, but then they say, well, why don't we start with 50? That's fine. You know, you're not trying to push for that. You don't care. Your job is just to teach it right. What you don't want to do is go out there and let people go, well, yeah, let me just do $5,000. You know, I mean, is that their right to do? Sure. Let me do 10,000. But you just need to really be emphatic about the fact that, sorry, Ryan, I'm getting on my soapbox a little bit here, but you need to be emphatic a little bit about like, that's not going to do you any good. Okay. You could have just gone to Costco and bought you a gold bar when they were selling it for that. So, oh yeah, Ryan, help me dig out of my hole I just got myself in.
It's a good hole though, and Kerry, let's point them to the training here in a minute of how they can access these on-demand videos so they can have the proper education. So we don't have a soapbox, but I mean that's correct, Kerry. If you present this asset class to a client, and you share with them why it's important, you share with them the $40 trillion of debt, you share with them how the equity markets are at all-time highs, the PE ratios are way out of whack. They know all this stuff anyways because they see it on Fox News or wherever they're watching their news, right? All we're doing is adding a last puzzle piece that without that, they're without insurance. And I like to tell folks, when is the best time for health insurance? It's not, you know, not when you're sick, it's beforehand, right? And you shouldn't get rid of your health insurance if you feel well today either. The whole concept here is providing the lessons and the principles of this is an asset allocation, should be 20%. And this is what 20% represents for you, Mr. and Mrs. Jones, and let them choose after that. And, you know, we don't get $5,000 cases from advisors that are educated. It doesn't work that way. I mean, we're averaging over $100,000 per transaction because it needs to be enough to make a difference.
Yeah. And the CFPME's got to speak up and just say, obviously your income planning's got to be done. The money's got to be used that they're not needing to liquidate anytime soon, right? It's the same mentality as like an FIA. It's a longer term hold, but they have that longer term money sitting over there. So they, you know, you should be segmenting that anyway. So absolutely. All right. So you've already taken care of number one. You watched the webinar. That's why we do it. Then there's a quick start kit that we built for your training. You get that, get your training done. Ryan's going to talk about that next, and then send out a simple email. We say, open your mouth, right? Because it's a fun conversation to have. It's not anything you have to be intimidated by.
So before we go any further, to get your quick start kit, and this is where, you know, this isn't an infomercial, right? So type in the URL goldandsilveradvisors.com. Okay. We have a cost to it just because we don't want XYZ person in there. We're going to give you a free code here at the end to get, just because we want you into it, right? We're not making money on this. This is just to make sure we don't have noise come into our system, right? But once you do this, once you get logged in and accessed, it starts a chain reaction. Okay. My team, my office, Kerry, I think you mentioned this. You called us a glorified IMO, but for gold and silver. That's what we are. My team will contact you. We're not spamming you. We're going to be contacting you for print logos. We're going to contact you for, you know, because we're going to make doodle videos for you. We're going to make you look good in front of your clients. We don't charge for this. We're there to help you. Okay. But what this does, this link, it gets you access to everything, all client material that, you know, you're able to, I think there's a link to our advisor podcast, which is on there, which, you know, has 20 plus episodes, Kerry, of timeless conversations that you and I have. But inside of this training, this is what it's going to look out for you. You know, key topics. What should I say to my clients, right? Some of the talking points that we mentioned earlier, that's all in there. What types of gold and silver should you be positioning your clients into? Not all gold and silver is created equal. It's real simple for non-qualified, Kerry, right? It's
Yeah.
one kind of a gold coin and one silver coin. That's
Yeah,
it.
and one piece of paper to place the order.
One piece of paper, right? But my main thing, Kerry, is I call it lesson number 3, and you can see how short these are, folks. We're not taking up your whole day. It's just actually about an hour and a half of your time. Is the correct mindset, right? To make sure that we're all on the same page. We're not peddling coins. This isn't a substitution to what you're already doing. We talk about pricing clarity, how to bring this up to your clients, how to talk about it, our order process. And you mentioned, Kerry, our non-qualified transactions are 1 page. We haven't changed that in 20 years. It's still that same 1 page, and that's what's beautiful about it. And then we have logistics, right? How things work for qualified funds, and how the metal is stored for them per the IRS requirements versus non-qualified. They actually receive physical possession. Those are the 2 distinctions. Okay, so Kerry, go ahead, add to what I mentioned there.
Yeah, absolutely. Hey, we revamped this training earlier this year, so it could be more concise. That's it, you guys. I mean, you're either interested in this or you're not. I encourage you to sign up and get the education, but you have to do your own due diligence. You have to have conviction about it. And when you learn what I learned a long time ago, I mean, when there wasn't no training when I first started with Ryan, it was my 20-minute phone calls and me taking notes feverishly. But anyways, it's a fun topic to talk about. Do not underestimate the power of his team, the materials they already have to equip you with. He didn't mention it much, but they'll do webinars for you. You can do an e-blast to your client base, coordinate with NFI. Bill and them are going to help you coordinate all of that together. And next thing you know, you're getting new relationships, you're enhancing old ones, and it becomes a real positive thing. You just got to get going on it. And I've never regretted bringing it up once ever in my career. So here's the coupon code NFI 2026 is what you'll put in at goldandsilveradvisors.com when you go there to get access to the training. There's also probably an older version. I don't know if Jacob's updated it. There's a replay of a webinar like this on there as well. So Ryan, close it out. Then we'll turn it over to Bill, and it's been great to be with you guys today.
Yeah, you bet. The coupon code is case sensitive, so that is a capital NFI. Just so your folks are on there. The way I see it, Kerry, there's no downside to it for folks on this right now that are live with us, or maybe you're watching this as a recording here at a future date. There's no real reason not to do this. You need to become educated. It does not take much of your time. And that's the beauty of this training that we just revamped here earlier this year, Kerry, that we had. I mean, it's timeless, right? But we wanted to, it's crazy. We looked at our previous training that we had, and it was all pixelated and older technology. That tells you how, I still didn't have any hair, but it tells you how timeless this conversation is. Okay, and that's the beauty of it. So become educated. Type in this coupon code. This is that checkout, so you don't have to pay the $200, and we don't want that to be a barrier of entry. So, but I want to thank you all for being on here, and thank you for NFI folks. NFI sees it this way, right? We want to make ourselves as complete advisors, right? This isn't a substitution, and we've found this over the last 20 years working with advisors. This brings in more business. This brings in more annuities. This brings in more prospects by utilizing this lure in your tackle box, right? It's another arrow in your quiver, whatever you want to call it. That's the beauty behind it, and why NFI, we appreciate y'all, and I'll turn that back over to you, Bill. So thank you.
Yeah, no, and I appreciate you guys. I think it's an excellent topic. I mean, some of the things that I kind of took from it is, number one, it just complements what it is that we're already doing so well. We're constantly talking about providing, protection from various kinds of risk. The second thing I love about it is that it is easy. The process is easy. It's not complicated. Sometimes you can introduce other areas where you're going to or talk about asset allocation, those kinds of things, and it can muddy the water. This does the opposite of that. It's easy, it's uncomplicated. And I think really there's a couple of things that you end up doing for yourself. One, you've separated yourself from the pack because you're addressing an issue that is either already on their mind, or maybe it's something that they didn't think of, and they are recognizing you, as I think, Kerry, you said, that they're really taking in a holistic approach to my finances in the long run. And then 3, obviously you're creating another revenue stream for yourself. Why leave money behind if you can address it in some form or fashion that benefits your client and puts you in a position, again, to continue to earn money? So for me, I think anybody that's on this webinar right now, you need to be strongly considering. If you're mildly interested, you need to be, calling in. As you said, there is no downside to this. So hearing the rest of that story, taking that next step, I think it's critical. Give us a call. I know we in this office, my team is going to be reaching out to you guys. So again, I appreciate your time today. Thank you for the education, and hopefully the individuals that are here are going to take action, because ultimately education without action is useless. And I have a feeling that there's a lot of people that are going to be taking advantage of this kind of thing.
Thank you, Bill, Ryan, and Kerry, for an excellent presentation today. We also want to thank everyone who joined us. We appreciate you spending part of your day with NFI today, and we hope that this webinar provided valuable insights that you can put to use in your own business. If you have any additional questions about today's discussion, please reach out to NFI. We'd be happy to continue the conversation and help however we can. Thank you again for joining us. Have a wonderful rest of your day, and we hope to see you at our next webinar.
You too.
Excellent.
See you guys.
Thanks, guys.